Good morning, everyone. It's my pleasure to welcome you to another SMFS PMS webinar. Thank you for taking out the time to join us this Saturday morning. This itself shows your great commitment towards gaining knowledge and growing your wealth. And that's what we're here to help you with. Our focus today is going to be on the Stallion way of investing, creating alpha in your portfolio. The flow of the webinar is going to be very straightforward. We'll have a very brief presentation by Amit, followed by Q&A. We'll have a very informal discussion where you can jump in whenever you want, ask your questions, and we'll just keep it going. Let me start by introducing Amit. Mr. Amit Jeswani is the founder and chief investment officer at Stallion Asset. He's a double charter, having successfully completed his chartered financial analyst from Virginia and chartered market technician from New York. He is a graduate in business with finance from Kingston University, London. Amit has been investing in capital markets for the last 14 years, starting at a tender age of 16. So Amit, can we start with that? How that journey began at such a young age?
So Shrey, it's actually been now 17 years. So
all right.
I started because my father was a stockbroker. And yes, so that's how I started investing in the markets. And now that's the only thing I know. So I don't see so much IPL, unfortunately. I don't see football. All I understand is, somewhat understand is the markets. And it's worked okay for us and our customers. So it started off as a passion. And once you're there in the market for 3-4 years, it gets into your blood, right? And you can't remove that out of the market. Not possible.
Definitely, definitely. So Amit, would you like to start with a brief presentation?
Shrey, I don't have a presentation, but broadly I can, of course, brief what we do at Stallion. So just a broad brief introduction about Stallion. Stallion started way back in 2013, and we started off as a research desk. We did very well for our customers there, and in 2018 we secured the PMS license. So the only way to become big in our kind of business is create value for our customers. That's what we understand. We're very, very, very customer focused. In 2018, the first full year, that is 2019, we were up 27% net of fees versus 6% for the benchmark. We beat the markets by about 20%. In the second year, that is 2020, which was the COVID year, we were up 41% net of fees versus 16% for the benchmark. That was the second year. We did well, and we beat the markets by 25%. The third year, 2021, we broadly were up 40% net of fees versus 30% for the benchmark. So we beat the markets by broadly 10 percentage points. This year, we're down 8-9% year to date. So that's where we stand overall. We've broadly compounded our customers' capital at 28% since inception. Now, the first question, which a lot of people ask me, is that did we take a lot of risk to generate these kind of returns? The answer to that question is no. In fact, our portfolio beta, which is our measure of risk, has been 0.84 against Nifty 500, which is our benchmark, and it's been 0.77 against Nifty 50. So we've taken way lower risk than the benchmark, yet we have comfortably beaten the benchmark by a large margin. How do we do this? We typically invest in 4 sectors: consumer, pharma, technology, and financials. We believe consumer and pharma are not so much linked to the economy, and they will help us in bad times. And this is what data over the last 20 years shows you. Whereas financials and technology will be the growth drivers of, and for any emerging market or even developed markets now, the largest profit pool accumulation happens in technology and financials. I'll give you an example. Nifty 500 total profit pool is 6.5 lakh crores in FY21. Out of that, technology is 91,000 crores. And in that 91,000 crores, you have your TCS, which is 33,000 crores. You've got Infosys at 20,000 crores, HCL at 11,000 crores, Wipro 11,000 crores. Then you have your LTI at 2,000 crores. So that's how the profit pools are broadly divided. In every large nation, be it China, be it US, technology as a percentage of all profit pools are closer to 50%, between 40 to 50%, depending on which market you look at. India as well, the total profit pool I said of Nifty 500 is 6.5 lakh crores. In our humble opinion, that profit pool from 6.5 lakh crores will move to 17 lakh crores in next 10 years. Okay, broadly 11% compounding of profits is what this is. Now we as investors need to find out which are those companies who will get that incremental 11 lakh crores of profit. Which are the, and that is what our job at Stallion is, to find companies, and we divide our portfolio in two parts. One is the hyperscaler part of the portion of the portfolio. These are companies which grow at 20, 30, 40%. Okay. Every industry in India grows at 12%, right? A great company is one which can grow at 2 times, 3 times faster than the industry growth, gain market share, and yet it is a leader. So I'll give you an example. Everyone looks at a shark in an ocean. What you want is a leader in a large opportunity size. What we look at is hungry sharks in an ocean. Okay. We don't, example, we will not buy a Maruti because Maruti is 55% market share of the total industry, right? So Maruti possibly cannot grow at more than the market, right? What we want ideally is companies who are 3, 4, 5% of the market. They are market leaders and industry growth is 10, 12%. And these companies can consistently year over year grow at 25, 30, 35, 40%. So those are the kind, and that is where largest wealth creation happens. That's the hyperscaler part of the portfolio. If you look at last decade as well, let's take last decade. Who were the largest winners? The largest winners of last decade were companies like Bajaj Finance, Astral, Relaxo. These companies went up multiple times, right? Avanti Feeds. These companies, all these companies were market leaders. Without market leadership, you will not have large market capitalization. That's a key thing. So we look at market leaders, but we also look at scaling up, the ones who are scaling up. So we will, in our hyperscaler portfolio, part of the portfolio, we will not buy companies which are growing at 10, 12, 15%, because that is what market growths are, right? We want higher growth in, so we are growth investors by nature, but growth at, with a few characteristics. These companies need to have a very high ROIC. So for the markets per se will always respect companies who will grow faster than the typical industry. So yes, so that is how we do it in all our portions. So in consumers, we don't have so much FMCG. We are more focused on building materials and retail, right? Building materials did well last decade as well. It will do well this decade as well, because building materials were growing at 12, 14%, even without real estate recovery last decade. This decade, we do expect at least the velocity of real estate recovery to happen with great space. So retail, you get same store growth. So so an HU or a Nestle will probably grow at anywhere between 8% to 11%. But if you go and understand retail, your same store growth is 8-10%, and then you keep adding new stores. And retail is very nascent stage, I would say, in India. Organized retail. No one player is more than, like, the biggest retail, if you think about it. Titan 6% of the industry. DMart is 0.5% of the India's retail market. So these companies, for a very long period of time, will keep growing at very, very decent rates. In QSR, you can find some names. QSR has given more returns than technology also in the US market for last 30 years. And you can break that data up every 5-6 years and you'll see QSR give. So retail is a very good space. In financials, we don't try to go very small cap, right? We don't believe small cap have an edge in financials, right? The one with the lowest cost of capital, the one with the highest technology, and financials are changing, right? The game is changing from branch banking to mobile kind of banking, and anyone who wins it. So banking is going to be about technology, and that we are very confident about. So the banks of 2030 will be very different from the banks of 2010. 2010, all managements had to do open a few branches, appoint some RMs, and these RMs would go out there and sell products. Today, it's become more of a cell phone. I don't remember when was the last time I went to a bank, to be honest. It's gonna be more of technology, and but yes, so financials typically grow at 1.3 to 1.5x your nominal GDP growth. Okay, so in India, your GDP growth is 6-7%, 5% odd inflation. Credit in India will grow at 14-15% for next 1 decade. Now, if credit grows at 14-15%, you need to find companies who can grow faster than that. But in a banking kind of business, it's not just growth. It's about making sure that you can get the money back, right? Only the last 2-3 EMIs that you pay is what is profits to the bank. Till that time, till like 50, out of 60 EMIs, the last 3 EMIs is what the profit is. If a bank doesn't have the ability to get those 3 EMIs, then it's just made a lot of losses. So that's on the banking side. On pharmaceutical and Make in India, this is one thing that we are getting aggressively more bullish on. This I would replace now pharmaceuticals by Make in India. Make in India is something which at scale, I believe that China plus one, which so if you think about it, now we call it China plus one. 4 or 5 years back, we called it Make in India, and we've never been very convinced about this entire theme. But growingly, our understanding is, except a few quarters of margin pressure because of commodity prices, this theme is here to stay. And Make in India as a story, be it from electronics, be it agrochemicals. We've got new companies which have got listed there, which have 40-50% ROEs, and they're trading at 14-15 P multiples, right? And they have a very strong growth track record. So there are a lot of opportunities in Make in India as a story, I would say, from electronics to agrochemicals. Yes, these and chemicals also, but you need to see like chemicals. Every chemical itself is a sector, so I would not broad base the chemical. So a phenol is very different than someone who is doing ABS chemicals in the chemical basket. So you need to understand every basket. But Make in India as a theme, I do strongly believe that game is going to get started, and it's going to get started in a very large way. So what do we not do? We do not do companies. So what we want is predictable, scalable, durable growth, right? If you can get that, and it needs to grow year over year. If it grows 2-3 years and it doesn't grow, or growth falls down, you will see very large drawdown in stock prices. Typically, our clients are very happy if we can compound their capital at 18 to 25%. That's what we target. In a 10-year period, 18% compounding will do 5x their capital and a 26% compounding would make it 10x their capital. Typically, this is what our goals are. Of course, this is not a guarantee, and we do expect 2 large drawdowns to happen in a 10-year kind of period in the markets, and we'll have to go through it. That's how we've done the thing. But our portfolio is low beta. Coming back to our approach towards what are the kind of companies that we select? There are 2 kinds of companies which we love the most. The first one, I would call it reinvestment modes. Companies who generate cash flows and can reinvest a large part of that cash flows at very high ROIC. I'll give you an example of a farmer. If a farmer has 100 rupees today, okay, he's a smart farmer, he generates 33% ROIC. That means in year 1, he gets 33. Year 2, he gets 33. Year 3, he gets 33. At end of year 3, if he has a very large opportunity, all he has to do is buy one more land, right? Assuming he gets, he does 33% ROIC there as well. In year 4, he'll make 33 from land 1, 33 from land 2. In year 4.5, he'll have 100 back, right? 16 from both the farms, and he'll buy one more farm. This is exactly how great businesses are built. Something like a D-Mart, which is part of our portfolio. I know a lot of people call it expensive and all that, but we've been buying from day one of our fund, basically. So this is one stock where 100% of cash flows are getting reinvested at 25-30% ROIC. If you can get that for a very long period of time, so the number of D-Mart stores now is about 280 stores. The number of Tesco stores in the UK has a population of 6 crore people, is 3,900 stores. The number of Walmart stores in the US is 4,900, and the population of US is 32 crore people. So you have a very large opportunity in front of you, and you bet on the leaders. When you do that, and if you have growth of 25, because you get 8-10% growth of the inflation and premiumization, which an HUL gets, plus you get new store addition. So these are the kind of companies, I can give you more examples, but where you are consistently reinvesting capital at very high. Now, when you give high valuation, what you have to see is that how will this story get impacted, right? High inflation, no problem, right? Because you can pass on inflation. You're just a retailer. Low inflation, no problem. Modi, no problem. Mayawati, no problem, right? Joe Biden, no problem. Donald Trump, no problem. So if you get that conviction that you get very high industry multiples, and that's why consumer companies trade at very high multiples compared to other industries. The second kind of companies that we buy are companies which don't need capital to grow. Okay, these are companies like tech services. Okay, I'll again give you an example of a farmer here. Okay, the farmer has 100 rupees. He assuming generates 33% ROIC in year 1. That means he gets 33 rupees cash flow back. Now, if I tell you the farmer is very smart and every year he can grow his land by 20% or grow his yield by 20% without investing capital, then it's one of the best businesses to be in. Basically, every year he gives us that 33 back. Next year he'll give you 40 back, because all these are dividends, right? And these are asset-light companies in the tech services place, companies in the FMCG space. They don't need capital. Infosys doesn't need any capital to grow. Persistent doesn't need any capital to grow. All it needs is computers, right? And if you have a large opportunity, so the total IT spends are $3 trillion in the world. The largest company in India, which is TCS, does about $23 billion of revenues. And there's a very large advantage which Indians have in technology compared to others. So even if today a mid-size IT company reaches a $1 billion revenue, a 7,000 crore revenue, you don't have to get scared, because that is very small in the overall outlook. He will scale. If you just have to make sure you're betting on the right horse here, and the valuations are reasonable in IT services, you will keep growing at 15%, in my humble opinion, this entire decade. A lot of IT companies, IT services companies will keep growing at 15% dollar terms. Plus you get rupee depreciation. Plus you get dividend, right? So your returns becomes 15% dollar terms plus 3% dividends that you get, which also protects your downside. Think about it. If an Infosys goes down, Infosys generates 22,000 crores of profits. This was the profit this year. I'll just give you an example. If Infosys stock goes down, all Infosys has to do is do a buyback. So that is what Apple used to do. And that's why large wealth creation happened, right? If you generate so much free cash flows. So these are two opposite investments. One where you're reinvesting, and one, but I'll tell you, you need to reinvest at very high ROIC. If you're not investing at very high ROIC, assuming, I'll give you an example again of a farmer. If a farmer has 100 rupees today and he's investing it 12% ROIC, okay, that means year 1 12 rupees, year 2 12 rupees, year 3 12 rupees. At end of 8 years, he will get the 96 back. Right? This is very slow compounding. So these companies who do 10% ROIC, 11%, they look cheap, but then they may not be cheap when you think about what will happen 3 years ahead. So that is what we do basically. We are, and what we look out for is low beta growth. So I'll give you an example. Let's take an example of Bajaj Finance. Okay, just random example I'm taking. Bajaj Finance also grows at 25%. DMart also grows at 25%. Okay. Bajaj Finance is a leveraged business to grow, and it grows at 25%. Right. DMart is a non-leveraged business which grows at 25%. It becomes a low beta growth and it becomes a high beta growth. Right. Not all growth is equal. The sustainability, Bajaj Finance might get impacted by very high NPAs and all that. DMart doesn't have all that. Once the product is sold, the profit is his. So we basically focus more on, and we allocate capital depending on what is the risk of growth and the durability and scalability of the growth in the business. So yes, so that's broadly about us. We look to do decent low beta compounding. We're not the high risk, high return kind of people. We are, I would say, reasonable risk and decent returns kind of portfolio is what we look out for. So Shreya, I don't know, like if I've covered, I can go deeper.
You can, of course. No. So you covered a lot about what you're looking at. So can we speak to some things of hygiene factors which you're completely against, that things like this are flags that you want to avoid and things that you don't want to enter the portfolio?
So we typically don't buy B2G. We've never bought B2G. So we don't believe B2G is business to government. So we don't buy companies who deal with government because they all go under litigation and money never comes back, right? We don't do G2B. So we don't believe that government typically in 95% times are very good allocators of capital. They're used for social goods, but they're not great for minority investors. That's not their priority. We would bet on an entrepreneur who's or a private equity who is running the show and whose interests are aligned with our interests. In the government kind of companies, they're good for social things, right? And not for this thing. We don't do commodities. So we don't believe we have the ability to predict commodities. So things which cannot be predictable are very tough to be invested. We don't believe we can consistently invest in companies who have 70-80% drawdowns and then come back. So you go more wrong than right. So we don't have any, let's say, commodities or steel in the portfolio. We don't have sugar in the portfolio. Right, wrong, that is how we are. We invest largely in four sectors: consumer, pharma, technology, and financials. We will not get out of our zone of understanding of predictability, right? So we need predictable earnings, scalable earnings in the portfolio. We don't want shocks and surprises. Of course, in markets, you get shocks and surprises every 2-3 years, but we know that things will eventually bounce back. So I'll give you an example. If you go wrong in a consumer company, okay, let's say you went wrong in a VIP, okay, you bought a VIP, okay, and 2 years COVID was there, no one was traveling, but you see things come back to normal in a consumer kind of company. That same thing in a commodity like business, you are not 100% sure because they're very, very, very heavily leveraged. And where you have leverage, we try to avoid it, because in India, to be honest, to get the 20% returns, you don't have to do all these crazy investing ventures. You will still do the 18, 20, 23, whatever that percentage that we do without doing all this. Then why do we do this? What's the upside of doing this if you know you're going to lose it all. So the whole game of investing is not just to make money. You will, a lot of people will make a lot of money in a bull market, give it back in a bear market, and your entire compounding goes for a toss. So the idea is not just to get rich. The idea is to get rich and stay rich.
So I think Mr. Ravi Garg had a couple of questions. Should I just ask him? Hi, sir.
Yeah, sure.
Yeah, thank you. Thank you, Shrey, for giving me this opportunity. Mr. Amit, I just wanted to know, you were saying that you are looking for hungry sharks in the ocean. So with that definition, why we are not looking for investment in green energy sector?
So green energy, we don't have many players, to be honest. All we have is Adani, who's aggressively there. You've got Reliance who've invested, but Reliance got many other businesses as well. So you'll have to buy it as a whole basket. We ourselves don't have any good understanding of where to get, who's the leader. So I'll give you an example, Ravindraji. Everyone was very bullish on wind energy in 2007, right? But there was no market leader. Suzlon was doing well. There was no market leader in India who was, or the world. And for last 15 years, everyone, literally, if there were 200 startups who were doing that, 1950 would have gone bankrupt. So that same thing is applicable for electric bikes. Okay. Electric bikes, there are at least 45 companies which I know who are trying to solve for this. So bikes, which was a 3-player market of TVS, Bajaj and Hero, Honda, basically 4, sorry, Hero and Honda became separate, but 4-player market has now become a 45-player market. Everyone is trying to solve for, be it Ola, Joy Bike, Ather, Ampere, I don't know, so many companies. So we don't want to be. I'll give you an example. Let's take an example of LED lights, okay, or like Dixon Tech. I'll give you an example. So, or let's say ACs. There is cutthroat competition in ACs in India. There is LG, Samsung, Voltas, Blue Star, Hitachi, O General, Daikin. 8, 9, and there is no unorganized market. Okay, we will not buy that market then. What we will do is we'll try to find the manufacturer of that component. If there is one player who's making 60% of India's ACs, okay, and all these guys are buying from him, I would prefer being there, right? So that is how. So even if there is a very high competition, Ravindraji, you will not be able to create a lot of value. You need to be in companies where you're market leader. So I believe India, let's say in India, there are only 60 lakh ACs which are getting sold. Okay, only 4% of Indian homes have an AC. That's a very small number. And AC is the only appliance where you probably have 4 ACs in a house, or 3 ACs or 2 ACs in a house, but you'll have 1 refrigerator, 1 microwave, 1 fridge. So there's a very large opportunity which is happening in the AC market. And then if you can find companies, the right kind of companies, and this same thing was there in China also. In 1997, China had 5% penetration of ACs. In year 2003, it went to 70%. So from 4%, it went to 70% in that 8-year period. That same thing will happen in India also, but you need to make sure you're not in a very heavily contested market, because in very heavily contested market, typically no one makes money.
Amit, I got your point. What I was referring to, maybe like AC is one part, but maybe the CNG, LNG, they are all hungry sharks and they will grow exponentially in times to come.
So we were speaking to one company. I'll give you, like, since this is just a private call. So we were speaking to EKC. Okay, they are into cylinder which is used in CNG, and they are CNG and LPG, and they are 50% of India's market share of CNG. And is that the theme that you're speaking about?
Yeah.
Or you're speaking about Gujarat Gas and Indraprasth and all that type of?
Not Gujarat Gas exactly, but like your H Energy, Total, They are very much in CNG business and LNG business. They are putting up H Energy. They are putting up lot many terminals for importing LNG. So they
But
are
sir,
looking
it's
to
tough to,
expand.
how do we bet on these stocks?
Okay.
There are no, like Adani Total is listed, but we'll have to buy it at 3 lakh crores. So we don't find the valuations very reasonable there, or it's beyond our understanding, to be honest. So Adani Total will be very tough for us to justify at 3 lakh crores, like market cap.
I'm not saying total Adani. Like okay, means just that was my thought process.
So we
Thank
were looking at new themes, but we will not buy a new theme without market leadership. So
Okay.
I'll give you an example. India Mart was a market leader. We bought it first day, first show, right? In the B2B subscription platform. And we didn't see there was any number two there, right? There are 1.5 lakh SMEs who are paying subscribers, 9 crore suppliers were there. So we bought it first day, first show. We made our 6, 7x and we are out 7, 8x. And we are out of the trade or the investment, right? Because the valuations didn't make sense to us that time. So we do back high growth companies, but we do not back it if they are not market leaders.
Right. Thank you. Thank you.
Without market leadership, you will not create market cap.
Right. Thanks. Thanks.
And
a
so
lot.
we have to buy only 20, 25 companies, right? So we don't have to think so much. In our 20 companies, if we can get the 25% CAGR, why go someplace else?
Thanks. Thanks a lot.
Sure.
Yeah. Anyone else who has questions, please feel free to raise your hands and we can just keep them coming. Meanwhile, Amit, so would it be safe to say that you're market cap agnostic, or do you have filters of you don't want your portfolio to have too high a percentage of small and mid, etc.?
No, we're not market cap agnostic so much. All we want is growth. We want a large opportunity size, a management who we can trust. But in management, there are two kinds. First is unethical. That means that he is, for us, it becomes zero, right? And value of an unethical management is zero. The second important part, which is very less spoken about, is the capability of the management, right? Unethical, you have to remove, that's okay. But how do you judge the capability? Is this guy who can pivot from one profit pool to another? He's the guy who will keep scaling up, because most promoters, once they start making a decent amount, once they start making, let's say 50 crores a year, 100 crores a year, they're okay. I have my BMW, I have my Audi, I have a nice house. Why do I risk what I have for something that I don't have, right? And they stop scaling. We want promoters whose businesses get better with size, right? A good business is the one which gets better with size. And these promoters need to have that ability to scale and pivot every cycle. So that is very, very, very important for us. So our first focus on the promoter is, of course, on ethics. That you come to know only by past history. Is the promoter ethical or not? And the second important part is the capability of the promoter to scale and deliver value for minority shareholders like us.
All right. So
that is very, very important.
Okay. So safe to say, if the management ticks the boxes, you're okay with smaller size companies as well, and you're okay with them being a significant size of the portfolio. Is that correct?
No. So historically, we've been 60 to 70%, I would say 60% large cap, 30% mid cap, and 10% small cap. So that has been our historical thing. But small cap is not like we are averse to small cap, but if we get something, so a 3, 4, 500 or 1,000 crore market cap company typically is not the market leader, right? So it doesn't fit our investment philosophy of buying into market leaders. So a 2, 300, 500 crore. So the breakout of that market leadership typically happens at 100, 150 crore profits. And once that, if a management is, the struggle phase is 25 crores to 100 crores. This is my experience, I'm telling you. The struggle phase is 25 crores to 100 crores. Once any company crosses that 100 crore profits, non-commodity, okay, non-commodity company crosses 100 crore profits, I believe by that time, all your managements, all your software, all your technology problems are over. Then your journey to 100 to 500 crores will be like a J curve. All your problems of people, processes, and all that. It's done by the company till the time the company reaches 100 crore profit. And then you get a J curve till 500 crores profit, I would say. And then they need to renovate again, because once you're 500 crores, you typically become a very large percentage of the market. And then you have to make sure that you build you start moving from competitive advantage to customer advantage. In a competitive advantage, you benchmark against your competitor and probably do better than the competitor. In a customer advantage, you go to make sure that whatever happens, the customer only buys your product. That should be the value, and you become basically an unbeatable monopoly.
All right. So basically, you're looking for the best point to enter before at the beginning of the J curve. That's what you're looking for.
And that time we get low PEs also. We get, let's say, 20 times free cash flow or 15 times free cash flow, and then the J curve basically starts happening. And that J curves are very powerful in businesses. If you get that market leadership and you get that you get that point right, you suddenly will get a J curve. And it happens in every business model. It's not just one business. It happens in every business model. And that's how you don't have to be the first one, but that point of expanding margins, expanding profits and revenue growth together, it becomes like a Lala Polaza effect, and you get expanding valuations also. Like something like an APL Apollo, which has been like an 8x, 9x for us in last 2 years. I'll give you an example. APL Apollo had 700 crores of debt in the book. So we never bought. APL Apollo was a market leader, but I've been tracking Sanjay Gupta ji for last 5 years. We've never bought APL Apollo. But the fact that he became debt free in June 2020, in middle of COVID, this person went off and paid off entire debt. Not just that, he was so scared that he said that I'm 50% of the market. I'm the market leader. And I still do business on receivables, right? He made his receivable days. He like, if you want to buy my products, you'll have to buy on cash, okay? Like upfront money. His receivable went to, today, APL Apollo is the only building material company which works on near negative working capital. There is no working capital involved. Your ROCs, which were always 20%, jumped to 40, 45%. But the stock was valued at, and it crossed that 100 crore profit mark last year. And today the profits are already 500 crores. So we made 4 times on the profit. Next year it should do 835 crores of profit. So that is that J curve where you're already a leader and you get that J curve. And that something happened in, let's say, other companies also, but it'll be more stock specific then. But that is what we are looking out for. So it was a leader, 50% of structural steel market share, large opportunity size for him. In building materials, I'll tell you, okay, in building materials, once a leader, always a leader, right? You don't look for companies who are very small percentage of the market, because there you will not make money. In building materials, something like a Polycab, okay, it is the market leader. It does revenues of 10,000 crores. KEI does 4,000 crores. Havells does 3,500 crores. The entire industry size is 45,000 crores. In building material, market leader will not change. Think about how many market leaders have changed, because building material business gets better with size. So your market leaders will never change in building material, not just in India. You look the same things in US, you get the same building material companies in China, and they're all 40, 50-year-old companies. They are not new companies who come, because when you're, let's say, buying a wire, okay, and let's say some other random company is 2% cheaper than yours. Let's give you an example of Polycab. I'm just giving you as an example, not a recommendation. We might have vested interest, but 10% is, let's say, 10% is, let's say, the PAT margin of Polycab. Polycab buys 10,000 crores of copper a year, right? If I come with Amit wires, okay, I will have to first pay 1-2% extra for my copper. If you're buying such large quantity, you get 2% cheaper. If my dealer margins for Polycab is 4%, if I come with Amit wires, I'll have to give my dealer 6%, because 6-7%, or why will the dealer keep my stuff, right? My production cost will not be the same as Polycab's production cost. So in a building material kind of scenario. Okay, you will, and think about it. What if my quality goes bad? How the cost of example, you buy some random cheap wire. If the wire has some problem, you will not break your entire house.
Sorry, please go on.
Yeah, yeah. So these building materials you have to see like Kajaria in the tiles space. That is virtually, look at who's the number 2 market cap. There is no number 2 market cap in the tile space in the country. I would say that like Kajaria. So in market leaders in, but here you don't see like yeah. So basically in building materials, market leaders will not change so easily. In fact, they will keep gaining slowly market share every year. Like Polycap gained of the organized market, he gained 4% market share and 6% in last 3 years.
All right. So a theme that you also mentioned, the PLI and manufacturing space, and we got a question during the webinar registration. So how are you planning to play the manufacturing space, and what are your thoughts?
See, first is that there are PLIs across. We played the electronic PLI very well. We did that. I would say now it's a game of consolidation and what next execution happens for the electronic PLI, because that was the first 40,000 crore PLI which came. Okay, now we have to see the further execution of that PLI. We're already seeing the electronic PLI game, which is now consolidating. There are margin pressures, this, that. What we are looking at is auto ancillary. The total auto ancillary profit pool in India is 7,000 crores. The PLI scheme is total auto ancillary profit pool in India 7,000 crores. Out of that, Motherson Sumi is 1,300 crores. MRF is 1,100 crores. Balkrishna does 800 crores. Yeah, so Exide does 600 crores. Amaraja also does 600 crores. Broadly 7,500. I'm just telling you from my own memory. I can be wrong by a few hundred crore.
Of course.
The total auto ancillary PLI is 26,000 crores, right? Now, and this is largely for the export market. India wants to be a hub in, so anyone who can execute so if your incentives in next 4 years is more than the profit pool, so you can basically understand the kind of profit pool expansion that will happen. Also, the first thing, signs are clear. You've had since 2018, the auto sales are down 40%, right? Two-wheelers are down 25% and four-wheelers are down 40%. After that, there are some auto ancillaries who have increased their revenue share. Okay, basically, even when the industry is going down, there are many auto ancillary companies who have increased their revenue. That is where you have to focus on. That in bad times, who were the guys which didn't get impacted? And now PLI will act as an export trigger. Now, outside India, India is the largest two-wheeler bike, even larger than China. Now, is the largest two-wheeler manufacturing or sales also happens in India. We already do about 2 crore two-wheelers every year. The big game is not two-wheelers. The big game is, of course, the four-wheeler part and how we can make for India. That is where the largest and focus. There are only 5, 8, 10 companies actually who do exports. So we are looking at that side, and they've got PLI license. Once the execution starts, I believe there'll be a Lala-Pola. That is the first side, I would say, where there's a large profit addition possible. Because the profit pools are very small and your scheme incentives are very, very large. That same thing is there with electronics also. The total profit pool, let's take Dixon Tech, the largest EMS player in India, has a total profit of 180 crores. The PLI scheme itself is 40,000 crores of incentives. Of course, they've not got all incentives, but you need to see where they are in the profit pool and what is the total. And there you'll get a lot of names in auto ancillary. That is what I think will be the largest kicker. A second, textiles, like I should not name stocks. Let's take an example. We don't have any position, okay, but something like an HP Cotton, okay. It got there are two PLI schemes. One where you do an investment of 300 crores, and HP Cotton is a small company which has a 57 crore market cap. We of course cannot buy it, okay. That has got a PLI incentive of 300 crores. The total profits the company has done is combined is 25 crores. We don't understand that part. That how is it possible that a company whose revenues market cap is 50 crores getting a 300 crore PLI incentive? Like of course we were surprised, but we look at data, and data will tell us where to be, where not to be. So we're looking at everything. But in food, we don't have many listed companies who've got it. It's all the Britannias and everyone who've got it. And Nestle's, but that will not impact their P&Ls in any material ways, I would say. So you need to look where incentives are large, market cap is small, companies are good, and there's an expectation of that profit growth happening. But you need to focus on those 10-15 players now in the auto ancillary space very carefully.
All right.
We don't have any exposure yet, but we are also basically
looking out. All right, I'll just give it to Gautam for a question.
Hi, Amit. Hi, Shrey. Okay, my question is specific to regarding a particular stock, which is Yes Bank. Okay, what's your view on its long-term scope for this particular stock?
My apologies, my sincere apologies, Gautamji. I don't even track what is happening in Yes Bank. So I don't even know the price. So it's not like I won't be, I know it's anywhere between 10 to 15, but beyond that, I don't even track Yes Bank. So
very nice.
I'm very sincere.
And any views on Jet Airways?
Jet Airways, sir, I don't track. So the airline is not even there. So why should we be in that? The airline doesn't run. It's very tough to create any value out. They are in default, sir. 8,000, 10,000 crores with the debt. In India, only you get Kingfisher Airlines. You should trade 7 years after Kingfisher was not there. But Jet also, there is only speculation, sir. There's no cash flows. There's no this.
Sure,
So you can buy new airlines if you want to buy airlines. Buy Jet.
Yeah, that's there. Yeah. Thank you.
Thank you.
So Amit, a common question that we keep getting now, this moves away from stock selection, more towards portfolio construction. So a lot of our clients are still on the fence when it comes to switching from mutual funds to PMSs. So what your thoughts or advice would be on that?
So I would say that mutual funds are better than FDs. PMS, you're taking a bet on a person. Most PMSs are, I would say, a person and an organized, driven, where you have massive skin in the game. Okay? It's not like professional money, I've got a salary attached. The only way I can grow, and Stallion can grow, is if I create value for you. Our motivation, so there's no large difference, to be honest, between a PMS. It's just that PMSs are more like every quarter we have a con call with our customers. It's more personalized that way. And we keep telling what stocks we did, what stocks we bought in the portfolio, what we sold. Take an PMS investment as example, investing in a restaurant. Okay. You have invested 1 crore in the restaurant. Assuming, I'm just telling you, your goal is that your restaurant will become 5 crores to 10 crores in a 10-year period. Okay. There will be 2 bad years for sure. But you are in business, you had COVID bad time, what you did? You still stayed in the business. Right? You will have 2 bad years for sure. You can see what galla is happening at any given point of time. You can just log in and see that what cash flows, what galla is happening at any given point of time. At end of every quarter, I'm the manager of the restaurant. At end of every quarter, I come to you and tell you, this is what we have done. These are our returns, these are the risks, and these are the changes that we've made in the portfolio, why we have made those changes, how your money is managed. Virtually everything is told to you. So you have a better understanding of where your money is getting invested, because you are the owner of the restaurant, and I'm just the manager of the restaurant. And Shreji is the Zomato. So he's telling you which restaurant is a good restaurant. So he's always there. He's always there to guide you. And yes, so that is how your entire, this is the largest, I would say, difference between the PMS, and there is skin in the game, right? There's very large skin in the game. You have very good understanding of what is happening to your money. And most people like to have that hang, right? Rather than not knowing anything, just knowing like a one-page portfolio stock. People need to know that where my money is getting invested, how is it getting invested. It's the savings of, it's hard-earned money of our customers which is getting invested, and we believe that we owe it to the customers to explain them how is it going, where are we investing, what are we cutting out, why are we doing what we are doing. So they have a very strong understanding and handle of where their own investments are going.
All right.
So it's serious, a little more serious money than mutual fund. Someone's investing 500. Also, the AUMs are different. If I had a 1 lakh crore AUM, I'll just give you an example. It's like riding a train, and you know how train does a U-turn slowly. PMSs are more like scooters and cars, right? If you don't like something, you just have to turn around and you can move ahead. The idea is to make money and manage your risk for your customers. So if we go wrong, we cut it out.
That's some great analogies there. I'll ask Mo to unmute if she has a question.
Hi, Amit. You mentioned a couple of macroeconomic factors like the China Plus One policy, the PLI scheme, as well as Make in India, which seem to be affecting the ancillary auto sector. Would you also think that it will affect the logistics sector, since some of the logistics players are seeming to be at least betting on it, since, you know, they obviously help in the transportation of the auto ancillary parts, etc.?
So we are very optimistic on the auto ancillary and the logistics. So the entire ecosystem does well, Madam Batwara. So it's not like only when I say when one industry does well, typically everything does well. Logistics, so you can't use so I spoke about the reinvestment of cash flows at very high ROIC. Okay, and I gave you an example of DMart. Okay, DMart is investing in appreciating assets. Okay.
Sorry.
Let's take an example of a logistics company. It is actually, if I have 100 rupees, that 100 rupees I'm investing in a truck. Okay, assuming that truck has a 10-year longevity. Okay, let's assume the truck has a 10-year longevity. Okay, that means I have to make sure that ROIC is 30-35%. And typically in logistics, the ROIC that we are seeing, because you're investing in a very depreciating asset, right? So we don't like so much logistics as a sector because they invest in very fast depreciating this thing. But we like if any companies can create a asset-light model, like something like a Shiprocket, right? Shiprocket has created, I don't know if anyone uses it, but Shiprocket is just an aggregator of so example, if Bombay to Delhi, you want to send a parcel, Shiprocket will say that Gati is offering the lowest price. He will give that order to Gati. And so the customer benefits, Gati also benefits. Let's say I want to send a parcel from Bombay to Bangalore and Blue Dart is doing at a reasonable price. He'll give it. So logistics will always do well. 99% of logistics industry is unorganized. And being unorganized is not a disadvantage in this kind of industry because they're very efficient players, I would say. Logistics, we are looking at VRL is decent. There are only 3-4 companies. There is TCI Express, which is listed. It's a very good business. He has created an asset like So Chandan Agarwal has created an asset-light business in PCI Express. This is the kind of business I like. If you look at
So a couple of questions from existing clients. I believe the current portal that the clients see, as of yesterday, the last portfolio update was on 6th April. So any plans to make it something that's updated daily?
No, it's always updated daily only because of the earnings season we made, because we're buying some stocks. Only when we are buying some stocks, like example, we're buying one stock in the portfolio and we didn't want to disclose that we are buying that stock. Only that time we make a lag. Typically, it's always fully shown to the customer.
Okay. All right.
Only when we are making some changes to the portfolio, which we don't want to disclose to the, like I'll give you an example. For last 15 days, we were buying Vedant, okay, like Vedant Fashion. So only because of those kind of stocks where we are buying slowly, and we think that the volumes are getting impacted. That is where we make changes. And when we are changing some large changes in the portfolio, that is where we make, so that it is for the benefit of the customer only. So that the execution price of the customer doesn't get impacted.
Okay, sounds good. And what would your advice to the clients be with respect to the fixed fee model versus hybrid fee model? What would your advice to them be?
See, historically, the fixed fee model has been cheaper. And this is what I believe, okay, that why should any client be sad if he's making money? Okay, the problem that we've seen that in very good years, the client is sad because he's paying higher fees. Okay, a client should not be happy if he's already made the selection of the portfolio manager. Okay, and the portfolios are not, so we don't even come to know which is fixed fee and which is like, we just see a person as an SACF. We don't even know the name. We know nothing about that customer. Now, once he's in the system, he's taken as every client is similar. There is no difference of customers, right? If he's already chosen the portfolio manager, then why does he want to give the higher performance fees, right? You are expecting yourself to be right, and why doubt your own stuff? That we've seen this over time, okay, that customers don't feel happy paying a large percentage of fee on a good year, and then they shift to the fixed fee model, which is not a good idea again. So both models are good. I would say fixed fee is more reasonable. I should not say it depends on the customer. We are happy with both, right? Fixed fee models are always more reasonable than the, if you believe the fund will do okay. Like even if the fund does 15%, the fixed fee models will beat the non-fixed fee model, and we'll do better also.
Yes, indeed.
Over time.
Indeed. So just for trivia, very trivial question. So has there been any stock or a couple of names that have stuck through since the inception of the PMS that are still in the portfolio?
So many, the core stocks have not changed.
Okay.
So many stocks have been same in the portfolio. I don't want to name them, but a lot of stocks are same since inception. The core stocks are same. I spoke about one retailer. I spoke about the bank and consumer part doesn't change so much, to be honest. The tech part, yes, it changes, of course. And yes, so those stocks have been same since inception. And they've been there for a long time, but yes. But some stocks will remain till the time they're growing. See, we don't think next 20 years. Okay, we do think 20 years, but when we take positions, we think next 3 years. That where will this company be in 3 years? It's okay to speak about 10, 20 years, but how will you know that you need to contain your risk? If you're not containing your risk, you are not a good idea. So we are very focused on this because market cycles are different. And what people like in 2010 is different. What people like in 2015 is different. What people like in 2020 is different. Not people like the businesses become such because of external, internal factors. You need to keep focusing on where you stand, and you have to be with the market. You cannot say that I will Like I personally believe that whenever I'm not with the market, I lose out. Okay, like and I have seen that being with the market makes more sense than being against the market. So while it sounds cool that you're not with the market and you're against the market and you're contrarian and all that, but you don't make money and you don't have a risk. Your risk is then unlimited.
Sure. So advice to clients who would be entering today, would you prefer them putting a lump sum or through invest via an STP?
Yeah, I'll be honest, like whatever revenues that we made in March, we are investing in next 1 week, 10 days, okay, when we get the revenues and the taxation is done. But for a customer, I typically never have said that go STP. But now if a customer wants, he can go STP because I don't expect markets to move a lot up or like it will be volatile. So you can go STP, but I never go STP. Whatever money we make, we basically invest. But for me, it's an automatic STP, right? Because every quarter, whatever we make, we invest in the PMS, right? So because that's the only thing we understand, and that's the only thing that we are very confident about, which will deliver very decent returns. But for a customer, if that's the only money that he's going to invest with us, then I would say that do an STP for next 5 months. We have a very nice STP. You can do it for next 5 months because the volatility is going to be here. I don't see volatility going away in a jiffy.
Yeah,
the volatility will be there for sure. So you can go by STP, no problem.
Right. And while we're of course believers of equity in the long run, we want current customers and future customers to stay for the next 5, 7, 10 years. But what would you recommend as the absolute minimum time horizon for someone entering your fund?
I would say you need to see at least one cycle, right? Every 4 years you have a bull market. You had a bull market in 2021. You had a bull market in 2017. You had a bull market in 2013-14 when Modi ji was coming. You had a large bull market in 2010. You had a bull market in 2007. You had a bull market in 2003. You had 1999-2000 Harshad Ketan Parekh bull market. You had a very large bull market in 1996 also. You had a very large bull market in 1992. So if you look fundamentally, every 4 years there's a very large bull market. You have to minimum stay from one bull market to another bull market. You cannot, 4 years I would say is the minimum time horizon. But the largest wealth creation happens if you can stay 2 cycles. So if anyone stays 2 cycles, your compounding goes to something else, because there will be times that we'll get it somewhat wrong, you'll get it somewhat right. But this is what, when I look back, like 2018 was a bear market, right? And I look at 2013, if my portfolio, where it was and where it is, you see times of growth. You don't see percentage. Then you don't speak about percentage, that the growth is, 100%. You say my growth is 15 times, 12 times, 8 times, whatever that number is. You speak in times in a 7-8 year period that I had invested 2 crores, that 2 crores has become 25 crores, whatever that number is. But you start speaking in times. You don't care about the percentage, but it looks very odd, saying that I'm up 1400% or all that.
Yeah.
So you start speaking in times, and that happens in the second bull market. So an 8-year period is a very nice period. 4 years is the minimum, I would say.
Okay. Sounds
if you
good.
want to speak in percentages, 4 years. If you want to speak in times, then 8 years.
Then 8 years. That's the right answer, I guess. Yeah. So Amit, thank you so much for taking our time. We'll just close this with one last question to you. So what would your one sentence of advice or investment mantra be to prospective future clients and maybe existing clients as well?
Ride the trend. We have to make sure that we are with the trend, we're with the market. We have to manage risk and respect risk. There is nothing, you have to be in the game to win. You cannot be out of the game and win the game. So my biggest mistakes, I would say, over last 15, 17 years is don't get scared by bad news. Think about it. The bottoms come in bad news. Demonetization was the worst news, right? Your 2 months, 3 months, your entire country was standing outside banks. That same day, markets bottomed out, 8th December. Lockdown was the worst news. And from my office, I can see like a lot of things. it was entirely quiet and shut. But the markets bottomed exactly on that day, 23rd March 2020. I have seen that bad news or wars and all that, we have to go through it. I've seen so many things now in the last 15 years. The day Lemon got bankrupt, next week the bottom got created in the SPX, right? Like the S&P. So bad news, if you panic on bad news, so the market keeps falling till the time the bad news doesn't come. And the day the bad news comes, that's actually the time the market starts moving higher, because first the shorts cover and then you'll start seeing good things happening. So don't sell the bad news. That is number one. Number two is ride the trend. Okay. And if there is money getting made, don't be in a very big hurry to cut your winners in your portfolio. If you want to make money, that will come from holding your winners, not by cutting out. And I have made most money in most hated stocks. So when I look back, my own history, because this is like I don't say all this, but my own history is that I made biggest money in most hated stock. When the first day we bought DMart, everyone hated it because it was at 80p. When the first time we bought Bajaj Finance, it's already been 8-9x, but people hated that stock. See, like, how can you trade at 5 times price to book? I bought it exactly on the same day where price to book of HDFC and this one was same. HDFC and Bajaj Finance had same price to book. It's been 70-60% CAGR story for me. When I look at my holdings in, let's say, Page Industry, that did very well for me. Like an Angel Broking was very hated stock when we bought it first time. That broking business, this, that. So you make money in hated business, but it needs to make a new high. So it cannot be hated and falling. That means you're wrong and the markets are right. It has to be hated and rising, right? So we don't have Tata Elxsi, but Tata Elxsi is hated and rising, right? Because nobody has. I don't know anyone who, even I don't have it, right? But you will see the largest money is made, the fastest compounding. It happens in hated and rising. So these are just small things which I think, but they're not like very, I can't put a science to it, but focus on the growth and focus on that trend growth. And don't let anyone tell you that, oh, this is cheap, this is expensive. That's okay. If it's cheap or expensive, you'll come to know in the price.
Yeah. Perfect, Amit. Perfect. Thank you so much for taking out the time.
Thank you for listening me. So nice of you. Thank you everyone who joined us today. Thank you so much.
Thanks, Amit. Bye. Have a nice weekend.
Bye. You too. Bye.